Hi everyone, Fritz here, and in this video we're going to go over the significance of investing in life insurance, also known as cash value life insurance. And if you saw my other video, which I'll link above, about the differences in life insurance, you'll know that permanent life insurances allow you to have cash value in them. But what is that? Cash value is something that is built in to permanent life insurance policies. These cash values you could look at as an investment. These investments allow you to grow your money while it's sitting in your life insurance. Now, when we're looking at these permanent life insurance policies, it's easier if we break it up into two segments. One is going to be the protection side. The protection side is going to be the face amount, which we have a set premium for. And in this example, we're going to use a $1 million policy that has a monthly premium of $1,000. If you pass away, you have $1 million. Or if you have a living benefits rider like long-term care, you can spend up to $1 million on your care in a long-term care situation. Of that $1,000 premium, let's say $500 of it goes to the protection side. Now, continuing on that example, the extra $500 and any money that we have extra will go into the cash value side because the protection amount and the protection price is fixed. So any additional money that we put into our life insurance will just go into the cash value side. The good thing about having your money in life insurance is that these life insurance companies, if you're not getting a guarantee, most of the accounts that the life insurance will invest your money in are conservative accounts that have downside protection built in. This is what allows them to give you those guarantees or those good ranges, say 6 to 7% every single year on average. Now, that might not be a whole lot to some people, but to have 6 to 7% consistently year after year after year over, say, a 30-year period, that compounding interest takes a huge effect. And you might be saying to yourself, well, what happens when I pull out the money? Do I get taxed on that? And the answer is no. The reason why is because if we look at the tax categories here, we see that we have 3 categories. Tax now, this is gonna be things like your bank accounts, where you get taxed every single year when you put the money in because you're using your post-tax money from your paycheck, and then you're taxed on the gains every single year. We also have your tax deferred section, which is gonna be like your 401ks, when you're not taxed when you put the money in, but you're taxed when you pull the money out. Life insurance falls into the 3rd category, which is the tax deferred or the tax advantage section. This category uses post-tax money, so the same money from your paycheck, but when the money grows and when you take it out, you're not taxed on it. There's no income tax, there's no capital gains tax. And the reason why is because specifically in life insurance, it's considered a loan against your policy. Now, some companies will charge you, if you're lucky, 0 to 5%. And typically, the older the policy, the lower the amount of interest that they will charge you. And the interest they charge you is just on the amount that you're pulling out, not the total amount of cash value. What's the drawback here? And the drawback is these tax implications for using cash value life insurance are only going to be active so long as your life insurance policy is active. So your life insurance has to consistently be active in order for you to benefit from this in that tax category. And the great thing here is that you can use this money for anything because you already have your protection money on the other side. This side, you can use it as a down payment on the house. You could use it to send your kids to school. And the reason why I say that is because if some of you who have a 529, the thing is if you have a 529 and you're eligible for financial aid, you will not receive financial aid until you use all the money in the 529. This is why some people use cash value life insurance in order to save for their kids' college tuition. But the most powerful thing that I've seen from cash value life insurance is when you're looking at something called sequence of return. Sequence of return requires its own video, but just to sum it up for you, the order in which that your investment loses or gains money does not matter so long as you're not taking money out. Sequence of return, however, does matter when you're pulling money out. Say like you have a 401k and you have cash value life insurance. In this instance, let's say that you would only use the 401k money when the market is up. And when the market is down, you can go to your cash value life insurance because in this example, it has downside protection built in. That way, you're always pulling from an account that has positive return from the previous year. Just take a look at the graph here. That it doesn't matter of your sequence of return, if you lose money in the beginning or if you gain money at the beginning. If the numbers all add up, you'll end up at the same place. Now, if we look at this other graph, where you lose money, or if you gain money in the beginning, as you're pulling money out, sequence of return has a huge, huge impact. And this is why people are using cash value life insurance as a retirement vessel for themselves, because they use it as a supplement with their 401k plan, with their personal savings. Because we're not in a day and age now where a lot of companies are giving out pensions. People are having to find other ways to fund themselves in retirement. And don't get me wrong, 401k is a great plan. It really, really is. But even in its conception, it was never meant to be the sole source of income in your retirement. It was only supposed to be a third. When it was first brought up, it was supposed to be a combination of 401k to be included in your personal savings, which coupled with a pension and Social Security would fund you throughout your entire retirement life. But because people are getting healthier, living longer, there's not as much money in Social Security to go around. Pensions are a thing of the past unless you have a state or federal job. So you have to increase your personal savings, but have it specifically strategized in a tax category that can benefit you. And that's what cash value life insurance can do for you. That's some of the positives that you can look at if you're investing in cash value life insurance. You're not gonna see drastic changes. It's not like the stock market where you see huge gains, but you're also not gonna see huge losses as well. So if you're going to use cash value life insurance for your retirement plan, just know it's a part of your retirement plan, coupled with other things. If you enjoyed this video about cash value life insurance, give this video a like, subscribe down below, and I'll see you in the next video.